Merhabalar Cüneyt. Thank you so much for coming. Mr. Dutta, am I pronouncing your last name
That's
right?
right. Yeah.
You're the head economist, the senior economist with Renaissance Capital Research. And your specialty is U.S. strategies, U.S. economy, equities, and other markets, of course, in addition to the global markets. Well, let's start with the FOMC minutes. We had it a couple days ago. Did it surprise you? Did you find it conflicting like the other economists have been putting there?
I think the minutes probably just confirmed whatever bias an individual had going in to it. I mean, if you thought the Fed was going to taper policy in September, after the minutes, you probably still thought the same thing. If you thought the Fed was going to taper in December, you probably still thought the same thing. I mean, ultimately, the minutes reiterated the fact that the FOMC remains data dependent, and the timing of winding down the asset purchase program, or at least slowing the pace of monthly asset buys, is dependent on the economic recovery. So if we were to get a strong employment report next month, my sense would be that the Fed would taper in September. They'd probably start small. I think if there was a bias in the minutes, it was a slightly dovish bias. I think the most interesting thing in the minutes was, while everyone's talking about tapering, how much is it going to be, when's it going to happen, the more interesting thing I think is what will happen next year. The Fed right now is talking more openly about cutting its rate guidance, the unemployment rate threshold, the forward guidance. Maybe if they take their unemployment rate threshold from 6.5% to 6%, that would help anchor the short end of the U.S. Treasury yield curve. So I think this is still a Fed that is going to remain quite accommodative, even if they are slowly tapering their monthly asset program.
You said that it is data dependent. We all know. How about the data? Are you satisfied with the data that's been coming? I know there are some ups and downs. Housing has been consistent, but you said, as you put it very well, the non-farm payroll, the labor market is the key, and then inflation. Do you think it is on the upward trend, or what are your estimates in terms of the data?
I think the U.S. economy continues to remain in a cyclical recovery that's in its early stages. And, my sense is that if you look at the data, since the last meeting, it's generally been positive. We had a disappointment. The employment report was slightly weaker than expected. These numbers get revised all the time. But if you look at the numbers that actually go into GDP, retail sales, that was better than expected. The trade deficit in the U.S. narrower than expected. The housing market numbers, they're relatively steady. Existing home sales better than expected. Home inventories up. I think the data is generally consistent with a better economic recovery in the second half, and that's actually consistent with the Fed's thinking. To me, it's not so much that the labor market has accelerated. It hasn't. I mean, employment has been at around 190, 200,000 over the first 7 months of the year. But that was in the face of a pretty aggressive fiscal consolidation in the U.S. So as the pace of that fiscal consolidation eases, I would think that there should be some pickup in GDP, some pickup in employment, as we get towards the end of the year. So, and for the Fed, it's always about the outlook and the fact that the economy's been stable and improved slightly despite some of the headwinds that it's had to deal with. I think that's a simple fact that the Fed should taper. The economy is less, there's less need for the economy to have $85 billion a month. So I think the Fed should feel probably somewhat more comfortable with the world, and because of that, that's why they're going to taper.
Is the actual data consistent with your estimates?
Yeah, I think if you look at the data right now, it's probably consistent with something between 2.5% to 3% GDP growth in the second half of the year in the U.S. That's pretty good.
So do you think it's going to happen in September, or it doesn't matter, like other Fed members put September, October, November, who cares? It's going to happen before 2014.
Well, it's going to happen before the end of the year.
But when is the question?
I mean, does it really matter? The markets are already pricing it in.
Pricing, perfect. That's the next question I was going to ask
Right.
you. Why are we seeing greens? Do you think we priced it in as much as we could already? There is no room for any downward movement in terms of the equity markets. I'm talking, of course, the bond markets too.
I mean, the bond markets, to me, have priced it in. I think they've probably priced in a more hawkish Fed than is likely. I wouldn't be surprised to see the Treasury market rally. between the end of the Fed meeting and the end of the year.
So it's not going to go up between 3 and 3.5 as BlackRock put it?
I think
you don't agree with that statement?
Well, I think it's very difficult for that to happen. I mean, to me, the real risk to the U.S. Treasury market isn't so much when the U.S. economy picks up. It's when there's an alternative safe haven. So if Europe continues on this steady growth trajectory, then there might be some more upward.
But it continues. However, it was not reflected in the European stock market. Yesterday, we saw very good manufacturing data coming from Germany, but the European stocks did not go up as much as we expected. How do you read that?
Well, I mean, the stock market's had quite a run already, so it could be just sort of a mild resetting of expectations. I think, at the end of the day, the European economy still remains very fragile. We all want to see it getting better. It's getting better very slowly. We'd be lucky to see 1% GDP growth there next year. So
we will be lucky to see how much growth again
1%.
For our audience? 1%. This is what you're estimating. But how about the outflow from the emerging markets, including Turkey, Indonesia, India, to the developed markets? 1.37, I think, trillion was wiped out for the last 3 months. So am I saying, do you agree that the emerging market is cheap, but the money is flowing out of there? Is it going to continue? What is your take on that?
I think emerging market equity markets are probably in a secular decline that has more room to run. I mean, they've been underperforming for a while now relative to developed markets, and I think that probably continues. I mean, remember that many of these countries never had much of a crisis to begin with. You look at China, India. They had very, deep recessions after the financial crisis, but very quick rebounds. There was a tightening of global trade finance, and that created a big drop in their GDP because they're so trade dependent. As financial conditions eased, trade recovered. And now they're kind of just bumping up against their structural growth potential. Global growth is a story about productivity, who sets the productivity frontier, and a lot of these countries have just exhausted their advantage of starting from behind. Productivity in China wasn't so much creating their own productivity; it was emulating what was already out there through foreign direct investment and so forth. So, I think a lot of these countries remain structurally challenged. A lot of them are tied, Russia, for example, Brazil, tied to the global commodity complex. That global commodity supercycle, I think, is over, and so that means it's going to be increasingly more difficult, given their current growth models, to sort of generate the kind of economic growth that we would want.
Thank you so much for coming. Our time is up here, but we would love to have you again, this time for longer. Evet, burada sohbetimiz sona erdi. Söz tekrar sizde İstanbul'da Cüneyt.